By now, I'm sure you all know the benefits of deferring CPP and OAS to age 70, and I'm sure you also know that the average Canadian would benefit from doing this, right? But even though this is true, there are still risks of deferring your CPP and OAS to age 70, and in some cases it could introduce new risks that you didn't have before. In this video, I'm going to walk you through a very common situation with a couple that has decided to defer their CPP and OAS to age 70, what happens when he passes away, and how you could potentially use something like life insurance to mitigate that financial risk. So here's the situation. This is a hypothetical couple, but I've seen this many times before in the real world. But let's use our favorite couple, John and Mary sample here for my YouTube video scenarios. So John and Mary are both currently employed. They've paid off their house, and they're looking at retiring in the next 10 years or so. Like most Canadians, it's not always easy to save money, but they've saved when they can. So they have RSPs worth a couple $100,000. They don't have anything in TFSAs right now. And so they are going to be relying on their CPP and OAS pensions to form the majority of their retirement income. Since both of them have worked relatively high-paying jobs for most of their careers, for this example, we're going to say that both of them are actually expecting to get 100% of their maximum allotment for CPP. This is very uncommon, but just for argument's sake, we're going to use that scenario here. So in order to maximize their income, they have decided to defer their CPP and OAS to age 70. They're currently 55. They're planning on retiring at 65, but they've already decided now that they're going to push off their CPP until age 70. They're going to do that with OAS as well. By deferring these government pensions out to age 70, it minimizes their investment risk, their longevity risk, and their inflation risk, because these are all guaranteed pensions that go up with inflation and they pay out as long as you're still alive. But now it's the million-dollar question: what happens if one of them passes away early? Yes, 100% yes, this is a problem. While dying in your 60s is not typical for the average Canadian, it obviously can happen, and it is a risk worth considering. So here's the problem with deferring CPP and OAS to age 70. So in this specific case, John and Mary both have the maximum CPP, and if one of them were to pass away, in theory, the surviving spouse would get 60% of the deceased's CPP pension. But hold on, the surviving spouse can receive 60% of the deceased CPP up to one's personal maximum amount. And so because both of them are already getting the maximum amount, if one of them dies, they're not able to accept any more from the deceased pension because they're already at their own personal maximum. So if John were to pass away, Mary wouldn't receive anything from his pension, and that income would just disappear. With old age security, there's no survivor benefit at all, so it doesn't matter when you take it or not in that regard, because there's no survivor's pension to consider at all, and so that is just a risk that you carry regardless of when you take your old age security pension. So before we go too much further with the theory, let's dig into some real numbers and see how this could play out in a potential real-world scenario. All right, so here we are in the software here. We're taking a look at a John and Mary sample. I got to come up with a better last name for my hypothetical people, but here they are. So by taking their RSP money first and then their pensions later and deferring those CPP and OAS pensions for a higher amount, they are just able to make their retirement income goal work. It's pretty close, but without that deferral, it didn't work out for them either. But now we want to see what happens if John were to pass away at age 71. So again, I've deferred CPP and OAS to age 70, and then what happens if John passes away the next year? So over here, we can flip this toggle, and I'll cut the video afterwards so we can run all the math in the background, and you'll see what happens in a second. So now in this case, you can see how at age 71, we've got this little alert here that says premature death, and that's where John passes away. And now this pink amount that you see going along here is the annual shortfall every year. And so because John passes away right after receiving his pension, they don't really get anything out of the pension, and all of it just disappears afterwards. So Mary is on her own because they've spent all their RSP assets leading up to that age 70 date when they're going to take their pension amounts. And now that he's passed, she's left with just the pensions. Now, these are larger pensions than she would have had otherwise, and they do increase with inflation. So we have a couple of options from here. So if this happens and Mary just has less income now and all the RSP assets have been spent, what can she do to make up that difference? Well, the first thing that you could do that many people consider at that point is downsizing your house. That's not a great option necessarily. It could be. Maybe they already had too big of a house and maybe that was something they were considering. I don't know. But when your spouse dies, immediately selling your house to come up with some cash to make things work isn't necessarily a great option or way that you want to spend your time necessarily. So I don't know if I would recommend that unless Mary was really keen on doing that on her own. If they still had a mortgage or a home equity line of credit on the property, that would limit how much money they'd be able to get back on the property anyway, so there could be some challenges there financially too. The next option is just kind of a no-brainer where you could just spend less money because she doesn't have the money to spend in the first place. Again, sure, great idea on paper, but if your spending need is actually higher than the income that you have coming in, of course that doesn't work. So maybe spending less could be an option, of course, but you can only spend so much, or you can only decrease your spending so much before you run into problems where it impacts your lifestyle. The third option is actually buying some life insurance. You might have life insurance already, and if that's the case, maybe it's term insurance. You could convert some of your term insurance to something called permanent insurance. It doesn't necessarily have to be universal life or whole life. You can get something called term to 100. It's just permanent insurance with no bells and whistles or anything like that, and that could be a decent option. Or you could potentially buy some insurance that extends beyond that period of time where you have the most risk, from when you're deferring your government benefits to when you actually claim them. So maybe in this case, a 20-year term could be perfect for a couple. Like John and Mary Sample in our case here. Again, you have to be healthy enough to qualify to actually purchase life insurance in the first place. So this might not be an option for everyone, but if you already have some life insurance in place, you could renew your term policies. You can convert some of it to permanent to make sure that it's there as long as possible. You can convert a portion of it to permanent insurance too, but all depends on the type of coverage you already have and your health status if you don't already have coverage in place. So in this hypothetical scenario, if John and Mary Sample decided to take their CPP and OAS at 65 when they retired, and then John passes away at 71 in that case too, what happens there is that they would spend less of their RSP assets up front because they have the additional cash flow from their government pensions. And so they'd be able to stretch their personal assets out a little bit longer so that if there is an early unexpected death, then the surviving spouse would still have some assets that she would be able to be flexible with and spend on her own however she saw fit during that period of time. The challenge is it's an unknown situation. It's a risk, but it's unknown. So it's really tough to plan for. So in a typical situation where you might look at your odds or your life expectancy to see how likely it is that you live beyond 75, 85, and perhaps older, more and more people are going to start coming to the conclusion that deferring their CPP and OAS actually makes the most sense for them financially. But if there is the unknown thing that happens, if you were to pass away early, say you're perfectly healthy now and maybe there's a car accident or something like that, then that is an unknown risk that you can plan for in other ways besides limiting your income potential from your deferral of CPP and OAS. So even in this hypothetical scenario, I don't know if it would be imprudent for them to take CPP or OAS later at age 70, but as long as they have some life insurance in place to cover those unforeseen risks if one of them were to pass away because of that situation of the CPP disappearing because your other spouse is already receiving the maximum amount from their pension. If CPP and OAS are all new concepts to you, I've got many other videos on my channel devoted to those topics, and I'm hoping to do a whole bunch more. If you've got questions about those, feel free to shoot them down in the comments, and I'll perhaps add them to my queue of videos to make in the future. Thanks so much for watching, and I will catch you in another video.